Hello everyone and welcome to this special weekday Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising, with Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters across the franchised and independent dealer sectors.
Hello and welcome to this Motor Trade Radio weekday special. We're delighted to welcome back Chris Plumb, Head of Current Car Valuations at CAP HPI. He's joining us for this exclusive roundup of how trade values performed over the course of October. Now, by way of a quick recap, last month CAP HPI reported just a marginal rise of 0.2% for September, which was very much in line with both the average for the month and the small monthly movements we have seen throughout the year to date. We'll also take a closer look at some of the key trends across vehicle sectors and fuel types, and Chris will also share some of his thoughts on how trade values are likely to perform in November and the rest of Q4. So welcome back to the podcast, Chris.
Hi Phil, hi Curtis, thanks for having me back.
Feels like we're nearly there at the end of the year, Chris, just to start another one very soon.
I know, 2 editorials before Christmas now. So yeah,
yes.
That's our countdown.
And you've got less time to do it in because you've got short months and fewer people in, with everybody using holidays up as well.
I know, certainly, especially the last week or two, it feels like most of the industry has taken the time to use up their holiday allowances. But yeah, why wouldn't you?
And event season and webinar season and award season, yeah. It's all on us now, isn't it?
Yeah, diary management's probably the toughest part of the job.
So, I mean, as always, we get yourself and Jeremy on. So let's kick off with obviously, start off with, talk us through, the headline figure at that 3-year 60 mileage point, One, how, what that movement is, what it compares to in terms of previous October movements into November, and probably as a way of as a follow-up with that, how this movement fits into trends in the year to date and where you expected it to be.
Yeah, of course, Phil. October kind of ended up as a pretty steady month overall. And when we closed off the data for November's monthly figures or monthly publication, we saw that values at 3-year 60, the 3-year 60,000 mile point, did slightly dip, but only down by minus 1.1%, which worked out to about £225. We think that's a fairly manageable adjustment, nothing too dramatic. But what's quite reassuring is that this movement is better than the long-term seasonal average, like kind of we've seen all of this year. I think it was only March this year, and the movement that we made was in line with the long-term seasonal average. That's going back to 2012 when we introduced Cap Live, but taking out the 2 affected COVID years. So the typical drop into November is roughly about minus 1.5%. So yeah, 0.4% stronger than that seasonal average. So it kind of shows that there's an overall resilience still in the market. If we look back at the strongest November, that was in 2021, which was actually, we saw values rise, a bit of a shock for that time of year, but 1.2% up. But that was the tail end of the remarkable run of the 8 consecutive monthly increases. On the other side, the weakest year was 2023, the start of that realignment and adjustment in the final quarter of the year, and values actually fell by 4.2%. So the 1.1% this year feels like more familiar, more in line with seasonal averages. But yes, it's still fairly positive. I think interestingly, though, when you look at where values have gone from a cumulatively perspective at 3 years for this year, they've only now just dipped into a state of deflation. So they're only down 0.3%. So a 3-year-old car currently is worth 0.3% less than at the start of the year. So again, a pretty strong indicator to just how stable values have been.
And how does that look compared to last year? Because it seems that it's probably a similar sort of position to where we were last year.
Yeah, I think it mirrors last year's movement. Exactly. So last year it was a minus 1.1%. And we think, and we'll touch on what's going to happen in future months, but when we look at where the volumes are this year versus last year, they are very similar. the market feels like it's in a similar position.
And within that minus 1.1% drop, and we'll look at fuel trends in a moment, Chris. But before we do, were there any notable price movements by age points for the month?
Yeah, so values did soften across all the age and mileage profiles that we report on. So at the 1 year mark, 1 year 10,000 miles, prices eased back 1%, which is roughly £370. The biggest drop came in percentage terms, at least at 5 years, 80,000 miles. That was a 1.2% drop, or £165. The best performing age point and mileage point was 10 years, 100,000 miles, which equated to 0.7%, which was a massive drop of circa on average about £35. But the movements, I'd say there's been this general seasonal softening across all the age and mileage points that we report on.
And turning to some of the vehicle sectors, how did they perform? And maybe start with SUVs, as they're by far the biggest sector that you have data on, aren't they?
Yeah, SUV is the most dominant sector in terms of the disposal data that we're receiving. But yeah, SUVs saw an average drop across all sizes of minus 1.1%, roughly £200. But as we said, SUVs now make up, or in October, made up 40% of all the sold transactional data we received. So if we narrow that down to 3 years old, they account for just over 60%. And to put that into perspective, that's a huge jump from 2019, when SUVs had a share of only 35%. So I think where there's more choice available in the market, buyers can be a little bit more selective for certain models, and we've certainly seen that this year. So we'd see that when there's a little bit more availability, it can put a little bit of pressure on some values. But there's been a little bit more nuance within the SUV sector performances. So if we look at large SUVs, they actually held steady at 3 years, not coming down at all in price at 3 years, but at 1 year they came down 0.3%. Medium SUVs saw the biggest drop at 3 years, and that's where we see probably the most concentration of data within SUVs, down 1.5% or £280. And small SUVs moved back 1.2% or £150. Touching on those noticeable movers, they did include models like the Qashqai petrol, Volvo XC60 diesel. Again, these are at 3 years, the 3 year point, but down 5.3%. Jeep Renegade hybrid down just short of 4%. Renault Capture down 3%. But it wasn't all negative, so let's not just focus all on stuff that's going down. There were a few models that we saw rise in value. So Audi SQ5 diesel up 2.1%, Mercedes AMG GLA was up 2%, and the Porsche Macan climbed 1%. So maybe the more premium end and the more high performance, but we did see some go up. And encouragingly, again, we'll touch on BEVs in the near future, but they did go up as well, which for SUVs, which was encouraging. Looking at some of the other sectors, I guess convertibles and coupe cabriolets, no surprise for this time of year. Again, seeing that seasonal drop off. Convertibles dropped circa 2.6%, and convertibles was the weakest sector, along with luxury exec that also fell by 2.6%. But on the other side, city cars and upper medium models were the best performance. City cars just dropped 0.6% or 60%, and upper medium also by 0.6% or £120. It seems that value for money, cheap running costs seems to be in buyers' it seems to be preference out there. The other sectors, other mainstream sectors, super minis were down 1.7%, £200. Lower medium fell, so that's like Golf Astrasize, fell 1.3%. Exec models eased back 0.9%. MPVs 0.7%. And sports cars were the ones that saw the smallest movement on 0.3%. But for all of those sectors and all of those movements, they're well in line with what we'd expect, actually better than what we'd expect for this time of year.
Yeah.
And I mean, Chris, turning to fuel types, and I think obviously it looks on the face of it in terms of that battery electric vehicle sector, the EV sector, looks like it was a positive month in against the overall movement. I mean, what drove some of the the resilience you identified for that sector?
Yeah, so BEVs have definitely stood out again in October, and again at the 3 year 60 mile benchmark. we saw the small BEV saw the smallest reduction of all fuel types, so just 0.2% down, or around 90%. And that's a continuation of the stability we've seen over the past couple of months. If you look at the cumulative movement just over the last 3 months, BEV values on average have actually remained flat and have been the best performing fuel type. I think last time when I came on, I said that we kind of seen this. It's kind of like a weird seasonality for BEVs, that they perform fairly well at this time of year, something that we saw last year, and that has continued, but it seems to be a little bit more extended this year. And we kind of think, well, what's driving this resilience and what's driving this uptick? We think it's largely down to the strong demand for more, or the more availability of affordable BEVs in the current used market. So BEVs priced between £5,000 to £15,000 have performed the best, and they actually saw values within that price bracket rise on average by 0.3%, or £20 to £30. These cars look great value for money.
And thinking about, I mean, how does that compare with plug-in hybrid sector and the petrol and diesel sector? Because I think they're the bit of inconsistency between those performers as well.
Yeah, so in contrast, traditional ICE vehicles and BEVs were the weakest performers. So petrol values dropped 1.4%, £275. Diesel 1.1, £210, and plug-in hybrids were down also 1%. Hybrids held up a little bit better, so self-charging hybrids, etc., just easing back 0.7. But yeah, it's really strong demand for BEVs at the moment.
And I mean, within the EV and hybrid sector, I mean, you talked through the price movements there, but were there any sort of standout makes and models, either up or down, winners or losers, in those sort of sectors that stood out for you throughout the course of the month?
Yeah, I think it's quite interesting now, monitoring it's been interesting for a long time, monitoring the different models within there. But again, it seems to be that clear standout about that. The vehicles that have been between that £5,000 to £15,000 trade price point, so sub £20,000 retail. So the vehicles that performed the best this month were the BEV Super Minis, and they were the stars at the 3-year point. So the Vauxhall Corsa led the way with a 4.6% increase, or £340 uplift, followed by the Peugeot 208 electric up 2%, so Stellantis will be happy, and the Renault Zoe up 1%. Yeah, but there was a few other models within Super Mini. Those are the ones that stood out. You've got BEV MPVs, again, very low volumes, but we're seeing a bit of an uptick on demand for Combo Lifes and Vivaro Lifes, up 3% and 2%. In the BEV space, in the SUV space as well, large BEVs rose on average 0.6%, or £90, and small BEVs performed even better. Again, those small affordable BEVs seem to be where buyers are moving their attentions to, up 1.1%, or £90. And within that, notable movers are the Audi e-tron at 3 years old, again up 2%, looks incredible value for money for the amount of spec you now get. The BMW iX was up 1%, and the DS3 Crossback also up 3%, and the Vauxhall Mokka up 2%, along with the Peugeot 2008 also up 1%. So again, more Stellantis product there. But medium BEVs, they were the exception. They did fall back by 0.7%, again, fairly in line. But if we just zoomed out on some of the more volume BEV models in the market, there was a bit more of a mixed performance. So the Tesla Model 3 held steady since the values moved, while the pre-facelifted Model Y did drop 2%. But let's put a bit of context on that. We saw more trade disposal data on Tesla Model Y in September than we've ever seen. No surprise, because it comes off the back of the exceptional new car registrations 2-3 years ago. But values only came back kind of in line with what you'd expect. October looked like we're also going to probably either match or even beat that monthly record. So that spike in volume, or potentially that increase in volume, is not having a massive negative effect on demand for Model Y. And we see it within our retail data that it does really well in terms of days to sale. Other vehicles that sort of bucked the trend was the Volkswagen ID3, sort of the pre-facelifted version, was up 1%, but the Skoda Enyaq fell 1.8%. Other models that dropped were the Polestar 2 and the MG4.
So it does, in summary, then, it does sound like that the market is now starting to see where, particularly you talk about that value point, that price point, they're seeing, that value in those used EVs now when it gets to that certain price point as a good value proposition for retail.
I think so. I think what's really encouraging is the beginning of the year, buyers, retailers, even used consumers out in the market didn't feel like they were actively seeking BEV product. It now feels like that has changed. Speaking to some leasing codes, remarketers, auctions, you have buyers phoning them directly saying, have you got any more BEVs? Are you hiding any that we can't see? Because there's a real appetite. So that is a massive change in the market. I think also what I've found encouraging this month is over the summer period, so we talk about that strange seasonality where BEVs perform very well. That may be corresponded with, there are a few lenders who are offering preferential rates on BEVs, so the monthly payments are certainly cheaper than the ICE. Some of those offers have been withdrawn, but we haven't really seen that had a big impact on the used values and tailing off. So maybe there's just more businesses out there who have got more confidence, because let's not forget they've dropped circa a 3-year-old BEV since September 22 has dropped circa 70%. So people who did stock them over that period of time would have lost a lot of money, but maybe it's starting to find that there's more confidence in the market, especially for that used affordable BEV, and start dipping their toe back in and finding actually there is demand out there. You can turn it quickly and for a profit.
And it was interesting you point on the Tesla Y, because as you say, that 3-year point was when they came quite heavily in volume into the marketplace. And I think there is reports that there is still a lot of that volume to come back still in the rest of Q4 into Q1 next year. And I think it's trying to get that balance right at the minute to make sure that it tries to stay within, seasonal normal depreciation, I suppose, in many ways.
I think so. I think there's lots of eyes on Tesla products, especially the Y. So it's encouraging to see, the movement that has been applied into October to November is kind of in line with what we'd expect off the back of more volume coming in. But let's face it, it's an SUV. It's a family practical car. It might translate well into the used market. So while there's lots of eyes on it, there's no reason why it shouldn't perform well, because I think on a retail forecourt as well, it's kind of Tesla's still a strong brand out there.
A strong brand, yeah, exactly.
Yeah.
I get what you're saying. But we'll be back after this short break with the rest of a look at Cap HPI's October trade values shortly.
You're listening to All the Chatter That Matters, a special weekday episode of Motor Trade Radio, powered by Motors, the driving force behind multi-site advertising.
Chris, returning to the editorial, each month you analyse retail activity by days to sell. How did they perform in October compared to September? And were there any notable trends by fuel type?
Yes, I think retail activity from the people from the retail partners that we speak to on a regular basis, actually said October's been generally okay for them. Most seemed fairly pragmatic, that it did tail off towards the back end of the month. But we've now had the clocks turn back. Depending on where you are in the country, it was either half term last week or this week or over both. So I think most people seem fairly positive about the market, that it's actually performed okay. But I say there's just been that slight tail off, and we've kind of seen that. So the average days to sell from the retail data that we analyse was about 41 days. Franchise retailers saw a slight increase from 35 to 37 days. Again, you kind of expect that maybe off the back of the new car month of September. Independents improved from 50 to 47 days, while the car supermarkets still remain the quickest at 35 days. Within that, talking about BEVs again, BEVs led the fuel type performance, followed by BEVs, petrol, PHEVs, and diesel. I think it's kind of October's performed how most people expect October to perform.
Yeah, and you also poll the views of the auction houses. What were they telling you about stock levels and trade demand for the month?
Yeah, I think that this kind of gives us maybe another indication to why values have been so resilient over the last couple of months, because there's been a consistent theme coming through our auction survey. not just this month, I think all year. But in our latest survey, 62 of the respondents said that their stock levels has actually decreased compared to September, while the remaining 38 said the levels were broadly the same. Critically, no one's reported an increase, which really highlights how tight supply still is, especially between that 3 to 5 year old price bracket, but also healthy conversion rates for this time of year. I think they're on average about 80% at the start of the month, dropped down to about 75%, but 75%. But that first time conversion means that there's less stock being re-entered as well. So that's kind of helping to it keeps those stock levels down. But this marks a shift from 2023. Again, that last quarter, which sort of we often talk about, because at that point, most of the auctions said that their volumes had increased. So yeah, it feels like it's in a good place. On the demand side, there were still positives to take. While October didn't perform or quite match the strength of September, when 100% of the auctions reported that demand had increased or held steady, the majority in October still saw stable conditions. I think 85% said demand remained about the same, while 15% noted a decrease. I say any softening in the market seemed to be related to more of the age, condition, mechanical flags on some of the vehicles.
And within the editorial, I did notice when you're talking about the stock levels that you point to newly generated used cars being channeled through alternative routes. Is that a polite way of saying pre-registrations being sold by franchise dealers?
It's not just pre-registrations. I think we've certainly seen an increase this year, but I think we need to caveat this and say we're not back at pre-2019 levels. There's just been a steady increase that we saw at the back of end of Q1 this year, end of H1 as well, and September. I think we've all heard about what happened in the last couple of days from a new car registration point of view, and all of that would have gone into pre-reg or tactical registrations. It's just when we're speaking to a few of our retail partners, a few have mentioned they've got a little bit more stock around them going into October than they potentially would normally have, and especially up over this time last year. And some of that is because of the opportunity to, some of it will be a business decision to take on those vehicles. So they'd like to move some of them across. But we are seeing a little bit of an increase. Obviously, when we benchmark them, when they're appearing in our retail data, we benchmark them to cap clean, because obviously we don't want trade or retail cars being below trade values and cap retail. And you would say 95% of the adverts are being priced sensibly and kind of in line with where we'd expect them to be. There's a few out there, but only a handful that we've had to realign some of our pricing, but it's very small on that. But yeah, we're kind of watching with a keen eye the volumes increasing, but I have to say, caveat that with we're still not back to 2019 levels. It's just an increase.
Yeah,
no, I'd agree. I think, like you say, I think there's reports that a good 100,000 or registered in the last 4 days of the month, and 50,000 on the last day of the month, or 24% or whatever that figure equates to. So I think, generally we'd expect that. I mean, second biggest month of the year, we saw it at the end of June as well. But as you said right there, Chris, that we're not back at the 2019 levels. So any increase, yes, it's up, but we are seeing that, as you say, if it's being managed right through the sector, then and again, it's by certain manufacturers, so it's not everybody doing it.
And I think there's a bit of a general misconception as well that it'd be some of the new entrants, and we might touch on that in the next question or so, about to increase their market share. But we're not seeing that within the data. And obviously, you can't actually sell a pre-registered vehicle. Is it legally for 90 days?
Yeah,
you can advertise it, so but maybe not sell it. But from what we're seeing, it seems to be some of the more legacy OEMs, and again, it's just pockets of models that we're seeing. It's not huge amounts; it's just pockets at the moment. But yeah, some of those cars, they do have to be priced quite attractively, because we know from a new car point of view, there's some really attractive offers out there. So that's the impact that we might see potentially. But yeah.
You'll have people shouting at their radio or wherever they're listening to the podcast saying 90 days, nobody keeps a pre-reg car on their system for 90 days. But anyway, we won't get into that debate. Let's get the crystal ball out, Chris, now. So, we're now heading into November. Sorry about that, everybody. We are. It's a fact. We're end of October, heading into November. It feels like we're in a fairly subdued supply and demand balance at the minute. Obviously, people start to think about, next year, 2026. I mean, what's your view now on, what we're heading into November? We've got the budget, the autumn budget on the 26th of November, which, that could be dampening activity and consumer demand at the minute because they don't know what's going to come out of that budget. What's your view on the remainder of Q4 now?
I think from a values point of view, we're predicting and still predicting that the movements that we're going to make are still going to be slightly more positive than the seasonal averages. So the average movement down from October to November is -2%. We think it's going to be slightly more positive than that, just again because of those 3 to 5 year old vehicles that currently aren't in the market. But the one thing like the budget has done, and the one thing that we'll want is certainty. So there's a little bit more of uncertainty in the market, and that comes from businesses and consumers. So we're all waiting with bated breath. But it seems for every story I'm reading one morning in the papers, it's then being retracted or saying that they're not exploring those options anymore. So I think we're all kind of second guessing what's going to happen. So until it happens, I think it's hard to really comment on it. But we are returning. It does feel, even though the movements that we made all year have been more positive than the seasonal movements, you look at the shape of this year and the way values are moving, it's more in line with seasonal deflations and the peaks and troughs we all knew and loved before 2019. So there will be that softening of the market going into the next 2 months, but we are not predicting a big realignment because we can't see anybody's got massive amounts of volumes to actually dispose into the market to stress it. A little bit more of an eye on some of that, maybe sub 12-month hold. But again, at the moment, it doesn't look like where those vehicles being priced are going to distress it. It's just more of the same that we've seen over the last month or two. So a seasonal softening of values to the end of the year, and then bang straight into January. And January normally does what January normally does.
And finally, Chris, we couldn't have you on without asking you about current valuations, which is very much your specialist area of interest within CAP HPI. Now, last time you were on the podcast, you talked about how you address values of the new entrant brands, but inevitably, since you were last on, we've had a whole batch of new brands either launched like Shangan or Geely, which launched this week, or coming soon like Aeon. What, if any, impact will these latest debuts have on Chinese car maker current values as a whole?
In terms of the used market, I think the early signs, what we're seeing from some of the new entrants, has actually been fairly encouraging. Now, volumes are very low into the market, but values have kind of held up reasonably well, kind of in line with more traditional legacy OEMs. Again, the one thing that when we're speaking to all these new brands coming in, and it kind of stands out, is their commitment to remarketing practices, getting plans in place. One thing we have seen from some of you can't say more established Chinese brands because they've only been around for about 12 months in the UK market, but the BYDs, the Chery's sister products, etc., is how engaged their dealer network is when vehicles do come into the used market the open market to purchase them and put them back into the network. So that kind of gives us encouragement. Again, everybody's talking about when we speak to these new brands, it's all about parts warehouses, supply chains, servicing. If something was to go wrong with the vehicle, that they can put it right, and they're on those high streets in everybody's towns and cities that people have been going up and down for years to buy or service cars, etc. So there's that local presence. So at the moment, we're not really seeing any deviation away from sort of what we'd normally see. So it kind of the early signs are fairly encouraging on that.
Excellent. I think everyone will be pleased to hear that. I mean, I think it's a question now going into sort of 2026 where we're still a 2 million new car market, and we've got all these brands coming into it, and who, when one of the new entrants takes a registration, it's taking it from somebody else, and it's all down to the winners and losers in that market. So we will continue to address this as on our catch-ups. I suspect, Chris, going forward. I don't think it's the last time we're going to talk about that subject. But I think clearly, appreciate you coming on today. I think giving the listeners a little bit more of an insight and detail around the editorial and that headline figure movement. We always say to anybody, if they've not had a good read of the editorial, it's very much worth it, because that's where the real detail is on this, and it's available through any of the social channels. If you check Chris's LinkedIn profile or any of the editors there at Cap HPI, you'll be able to get the editorial. We'll put a link on the usual newsletter on Monday morning. But I think you've also got a webinar coming up, which is, I think, next Thursday on the 6th at 2 p.m, Chris, I think, haven't you? And that will be sort of sharing from yourself and Dylan.
Yes, that's correct, Phil. So we have a webinar next Thursday at 2 o'clock, so the 6th. Anybody who wishes to sign up for it or wants the on-demand link for it, please just either drop me a message on socials or send me an email, and quite happily include you on that. But so we've got Matt Freeman from our consultancy department actually talking about, again, Chinese new entrants into the market, kind of what we're learning. So really hot topic, and we got some really good feedback from the last session we did on that. Dion will be touching on vans, LCVs, about the future and what's happening in terms of current market. And then Dylan will be touching on new car forecasts. I think we've just come off the back of an SUV sector review for forecast value, so I'm sure he's been kept busy with the inquiries off the back of that. So I'm sure there'll be a little bit on that as well. So everybody's welcome to join. So just send me an email.
And it's always a good opportunity, because you do have the Q&A session at the end, so to get the audience of you all in the various areas that you operate within, to be able to get you all on that webinar and ask you the questions is always valuable for anybody that is joining it.
Yeah, I agree. It's a good platform. We do them every 6 to 8 weeks, but please feel free, anybody who wishes to join, I'll get on the distribution list, send me your details.
Excellent. Well, again, from Curtis and me, thanks for giving your time up today. Appreciate you. You're busy. It's always a busy time for you guys there at Cap HPI. So thanks for joining us today, Chris. It's been much appreciated.
Good to catch up with both of you. Thanks.
Many thanks, Chris, and thank you for joining us for this special weekday podcast. Thank you for listening. We're back with all the big car retailing headlines this weekend. Until then, it's goodbye from me,
and it's goodbye from him.
Thank you for listening to this special weekday Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising. Philip and Curtis will be back with the week's big motor retailing headlines on Saturday. Live, on demand, wherever you are, on your podcast feed.